Welcome to the first session of the amazing journey of Trader School. In this session, I'm going to talk about the exciting journey we are about to take toward becoming a trader. And we'll also cover the basics of understanding market and trading. We are going to learn how to identify the key elements on a price chart. Then using those tools, we'll start reading the chart like a story. With the knowledge we gain, we'll be able to analyze and predict the market's next move with a high probability. And finally, take action and make trades considering risk management. Think of it like watching a movie. By picking up on the clues, you start to guess how it will end. That's what exactly we are going to do with the market. Before we begin, there is something really important to understand. Losses are a natural and unavoidable part of trading. We are here not to sell dreams to ourselves or anyone else. We are here to learn the real deal.
A candlestick
now let's get started with the basics.
During a specific period of time. For example, if gold became more expensive today, the price it started with is called the open, and the price it ended with is the close. If during the day the price went higher or lower than those points, the shadows show the highest and lowest prices reached. This type of candle represents one day, but we can also have candles for 1 hour, 1 minute, or even 1 month, depending on the time frame we choose. Now, who's actually moving the market? There are 4 main groups in the market. Big investors. These are people or institutions with a lot of buying power and no time pressure. They trade based on the intrinsic value of an asset, like gold. Corporations and banks. They also manage huge amounts of money. But unlike the first group, they do have time pressure. They need to show performance in reports. Professional traders. These are skilled individuals, and this is the group you'll belong to one day. They follow the second group closely and trade based on their moves. Beginner traders. This group usually ends up losing money, simply because they haven't yet learned how the markets work. Now let's see how each of these groups behave in the market. In general, there are 3 types of market movement. Uptrend, or downtrend, or range. Let's look deeper how each group acts in the market. The first group. They operate with massive capital over long periods of time, based on the intrinsic value of an asset. Because their moves are so significant, they often cause the market to go into a range while they accumulate or distribute their positions quietly. They are the main force behind the price movement. The second group. These players try to buy at the bottom of the range and sell at the top over and over again. They also participate in upward and downward trends when the opportunity is right. The third and fourth groups. These traders are usually trying to follow the big whales, hoping to catch part of the move after it's already begun. And this is how the price cycle is formed. Accumulation, trend, and again distribution. This is the price cycle. Even with inflation and fundamental factors in play, the market constantly moves between cheap and expensive zones, creating trends. During an uptrend, for example, the same price cycle diagram we looked at repeats itself again and again. Price goes up, pauses, and goes up again. This repeating cycle is how we learn to recognize market behavior and predict the next moves with high probability. We analyze the price chart using different timeframes. Each trader chooses their style based on their lifestyle. Some prefer short-term trades, others go long-term. There is no one-size-fits-all. But one of the most fascinating features of the price charts is their fractal nature. That means the price cycle we talked about can be seen on every time frame, from 1 minute to 1 month. Trends and patterns repeat themselves, just like fractal shapes in geometry. The more you zoom in, the more you see the same structure. For example, that was one-day time frame, and this is the 4 hours, and we can see here the 1 hour. Now, the most important concept of this session, the power of 3. This concept plays a critical role throughout your trading journey. The market doesn't just move randomly. Every major move follows the 3-phase structure. Sorry about that. First, accumulation, then manipulation, and distribution or expansion. This is where the market quietly built up order. The smart money is preparing for a move. In the second phase, a fake out or stop hunt happens to trick traders and shake out weak hands. And at last, the real move begins. The market finally goes in the intended direction with momentum. A professional trader knows this structure well and doesn't enter a trade before the manipulation phase is over. This understanding helps you avoid getting trapped and gives you the edge to trade with the big players, not against them. In the next session, I'll introduce market structure and how to identify premium and discount zones on the chart. Don't forget to subscribe so you won't miss it.